Thank you very much, Ali, and thank you very much for joining us today. My name is James Knoedler, and I'm here to talk to you all about the Curated Global Quality Equity Fund and who we are, what we do, and what we offer to our investors. And the title for today is The Quality Compounders: Resilience and Opportunity in an Uncertain World. This title was chosen a little while in advance, and interestingly, the world has become more uncertain than ever since it was chosen. Anyway, who we are, what we do, and what we have to offer. So we are Evenlode Investments. We've been around since 2009, and the portfolio managers on this fund are shown on this slide. Hugh Yarrow, off on the left, is our co-founder. He set up the business in 2009. He is the curator of our philosophy of our process and our culture. He has a wealth of experience in the investment world, having started in 2000, and he has day-to-day oversight of all the operations of Evenlode. And working on the fund day-to-day, myself, Christina Dyer, and Chris Elliott. And one of the themes of today, I understand, is investment is both an art and a science. Evenlode has had this from the start. Hugh is a philosopher by his academic training. His co-founder, Ben Peters, is a scientist who was actually working as a scientist at Oxford University when he set the firm up. And if you look at the people on the slide, our backgrounds, I actually have a degree in English from Oxford. Christina was a scientist at Oxford. She had just finished a PhD in immunology when she joined us. And Chris Elliott is by training a mathematician. He was at Cambridge. This is a balance which runs all the way through Evenlode. We tend to recruit people both with very strong humanities backgrounds and very strong scientific backgrounds. And there's a recognition that no one side on its own is sufficient to deliver the kind of service you need in this industry. You need both. And a little bit on what we do day to day. We're based out of the countryside in England, just as a legacy of where we were set up, a long way away from the noise of London and New York. But we invest globally, and we've always had the same principle, the same process, the same philosophy. And the principle, the motivation, the rationale is to preserve and grow the wealth of our clients. We are our own clients as well. And this slide 4, gives you a bit of detail on the setup of the firm. And the thing I would really like to stress, obviously, we've got to a decent size over time. It has all been an organic process. The philosophy is unchanged. And one of the things underpinning it, which is absolutely critical, is that we are owned by an employee trust, which is unusual in this industry, I think perhaps unique. And the structure of the employee trust is that all the current employees are beneficiaries of that trust. And the point of this is to align ourselves with our investors and to give ourselves the framework to roll on perpetually. We believe small is beautiful. That makes sense to be a boutique. We also believe that being a boutique has its own challenges in terms of handing on control and prolonging the life of the business by bringing new people in. And the trust structure is a way of addressing this. And then a little bit on the strategies we manage. So as mentioned, we were set up in 2009. We have never changed the bedrock of what we do. We invest in companies we define as quality. We'll get into that in a little bit, which are available at sensible valuations from the stock market. What we have done over time is we've gradually relaxed the constraints that were initially imposed on us. So the initial constraint was we would invest principally in the UK, and we would provide our investors with an income, a dividend distribution every year. Over time, we've become comfortable in our knowledge of a pool of wider companies globally, and we've added a global income strategy. And then over time, given that we are very focused on the bedrock of dividends, which is free cash flow, we became comfortable we could offer a strategy which did not offer a distribution. And that's the one I work on, the global equity strategy. And then as of last year, very excitingly, we have joined forces with Curate to make our strategy available more globally. Historically, we've been very UK-centric in our client base. And as mentioned, the down escalator piece is critical. In our experience, our hit rate, the number of companies who stay in the bar at the top, is meaningfully superior to that of the broader market. So our companies are in the down escalator at about half the rate that you see here. That's still roughly 1 in 6 companies in any given period of 5 years. So something you need to pay very close attention to. And that's where you need to have a toolkit for recognizing companies where the economics are deteriorating and a discipline to act on it once you have established that the deterioration is real, not a mere business cycle fluctuation. So, a couple of examples we've had Intel in 2020, we sold out of all of our existing strategies then. And we recognized that our initial analysis hadn't spotted how Intel's client base and data center is consolidating. And once you, I don't need to tell you guys this. If you go from having 1,000 customers to 3, you're going to be in a tough spot. Once we established this, we knew it was time to sell, and we weren't fussy on the way out. Because when we have a deteriorating business like this, we no longer have a map or a toolkit to anchor ourselves. And if we don't have that, we don't have any right to be operating in the shares of that company. So you don't wait for a good exit point. So we sold, and on the whole, very comfortable with that decision. In fact, not just on the whole, totally comfortable with that decision. Another example, Estee Lauder, where we recognized in the summer of 2023, having worried about it for a while, that this business had historically underinvested in its core franchises beyond our initial assessment. And we came to the conclusion that the required catch-up investment would be punitive on its earnings for the foreseeable future. And again, we took the decision to sell rather than try and time our exit. And again, so far, there's been the correct decision to make. The challenge is that capitalism is a competitive process, and companies are continuously trying to take away the excess returns on invested capital of their peers. And this leads to the dynamic that you can see in the top bar of high starting return on invested capital businesses. And this sample, by the way, I should stress, is repeated in many other studies of this type of business. So it's a durable finding. Companies with good returns on invested capital, which have them competed away, take what we call the red escalator down. And this is a punitive outcome for shareholders. As you can see in the right-hand box, it's the worst possible outcome you can get. And again, this is a robust finding. What you have is typically your earnings get worse, but also the market valuation of your company gets worse on top. Your multiple declines. And this double blow means that the returns more than offset the continued excellence of the companies that stay in that green bar. And this drives the bulk of our process. It's fairly easy, as you'll see in the next slide, to automate the selection of companies of good economics today. The magic lies in being able to discriminate between the good companies with sustainable economics and those where the economics are going to decline. And as mentioned, the down escalator piece is critical. In our experience, our hit rate, the number of companies who stay in the bar at the top, is meaningfully superior to that of the broader market. So our companies are in the down escalator at about half the rate that you see here. That's still roughly 1 in 6 companies in any given period of 5 years. So something you need to pay very close attention to. And that's where you need to have a toolkit for recognizing companies where the economics are deteriorating and a discipline to act on it once you have established that the deterioration is real, not a mere business cycle fluctuation. So a couple of examples we've had, Intel in 2020, we sold out of all of our existing strategies then. And we recognized that our initial analysis hadn't spotted how Intel's client base and data center is consolidating. And once you, I don't need to tell you guys this. If you go from having 1,000 customers to 3, you're going to be in a tough spot. Once we established this, we knew it was time to sell, and we weren't fussy on the way out. Because when we have a deteriorating business like this, we no longer have a map or a toolkit to anchor ourselves. And if we don't have that, we don't have any right to be operating the shares of that company. So you don't wait for a good exit point. So we sold, and on the whole, very comfortable with that decision. In fact, not just on the whole, totally comfortable with that decision. Another example, Estee Lauder, where we recognized in the summer of 2023, having worried about it for a while, that this business had historically underinvested in its core franchises beyond our initial assessment. And we came to the conclusion that the required catch-up investment would be punitive on its earnings for the foreseeable future. And again, we took the decision to sell rather than try and time our exit. And again, so far, there's been the correct decision to make. And this is the core of the Evenlode investment process. As you can see in this chart, we divide it to quantitative and qualitative pieces. Think about it as the number of doors you need to open to get into the portfolio. The first door is purely quantitative, and it's based on the profitability and the capital intensity of the business. You put them together, you get a return on invested capital, and also the leverage the business carries. This first door, in our experience, eliminates the vast majority, 90% plus, of all companies, listed companies in the world. It's too high a bar to set. The second door is more important because you can't automate it. With competitive advantage, you are looking for an asset the company has that competitors cannot buy. Typically, you're looking at a brand, a switching cost, or a network effect. These drive economics for clients such that the clients are willing to pay a handsome premium for these products, which gives you pricing power, which drives good margins. This on its own is not enough. You also want to see two other things. Firstly, you want to see structural market growth. As mentioned, we are looking to preserve client capital in real terms. It's extremely hard to do this when invested in companies where the top lines are growing at least at the rate of GDP, if not faster. The other levers you have to pull to drive shareholder returns are much more limited in scope. And the second piece is the reinvestment into growth. And this is critical. The competitive advantages I just touched on don't come for free. And what you want to see is a company which is willing to sacrifice some profits, some earnings, some distributions today to assure themselves of a good roadmap in future. And the next slide touches on this a little bit. What you want to see are some of the characteristics touched on here. And they come at a price. And this is what we think gives this strategy its durability, because human beings are always fighting against our desire for cake up front. Companies which can train their management, their employees, and their shareholders to defer profitability in the interest of the long-term franchise are surprisingly rare. And the fact that it goes against human nature means that this strategy has been able to deliver good returns, not just this strategy, but this philosophy of thought going back a very long time. I'd mention here perhaps the work Phil Fisher did on quality companies many decades ago. It's a sustainable market inefficiency. And then here we have a few examples of companies which make these sacrifices and then drive attractive profitable growth over decades. Some of them are very straightforward. For example, with Linton Sprudley, you can see the investment that they make into advertising, and you can see the investment they make into having new stores, particularly in new markets, which are run at a loss, often for many years, in order to build the brand. In other cases, though, these reinvestment lines are harder to identify. And I'll give you a few examples. MasterCard, for example, has historically been very willing to rebate revenues to banks, and also to give banks, the issuers of cards, credit cards, debit cards, the bulk of the revenue that comes out of the merchant discount rate, which is the the slice that's claimed by the credit card when you buy something in a shop. This revenue is very high margin for the banks and has no credit risk attached. And it's critical for keeping the banks profitable and able to deliver consumer banking. Attacking this line of investment is incredibly hard because you would need to sustain the profitability of your partners. It goes beyond just technological capability of the things that bank card networks do, like tokenization, contactless, fraud detection, loyalty, top of wallet data, that sort of thing. Likewise, Alphabet drives the revenues and economics of a lot of their key partners, most famously with Apple. About 20% of Apple's operating profit comes from their distribution incentives from Alphabet. Alphabet make the Android operating system available for free to a number of their partners like Samsung. They also rebate about half of advertising revenue to YouTube creators. They're a keystone company. Hermes is another example where it's even more subtle because there's no numbers behind it. They deliberately restrain supply of their key goods to their customers. This builds up a wait list of clients, which we think has got many years to run. This is a continued reinvestment in scarcity, which is the most valuable commodity you can have when you're talking about luxury. And then touching a little bit about how we align the company that we manage, our own company, with these values and this perspective. As mentioned, we are owned by perpetual trust, which aligns us for the long, long term. But again, we make deliberate sacrifices, and that's in the bottom rank. We have been deliberately restrained about the number of strategies we open. We don't have any intention of having a large supermarket of strategies. We have a circle of competence and we stick to it. This is sacrificing some earnings, but we think it increases the duration of our business and the value of the strategies we offer to clients. We reinvest in our team and our technology. We deliberately overhire younger people because we know that in future, while we have more people than we need to run the business day to day, they are our future. And the time to train them ideally is yesterday. The next best time is today. We reinvest into our technology as well to make it easier to see what we are doing. And then finally, we've soft closed our flagship fund already. That's our UK income fund. And our intention is to be soft closing over time because we understand that capacity discipline is incredibly important to our clients. And then a little bit on the process. So I talked about the doors earlier. The first door being, are the returns good enough? The second door being, can you isolate the ways the company has competitive advantage, has a growing market, and reinvest in its competitive advantage? Those are the first two doors, but they're not enough. The third door is understanding the company's idiosyncratic risk. We look at how levered it is. We look at how much cash it develops out of its accrual earnings. We look at the quality of management, the cyclicality of the business model, the ESG risk, and the liquidity of the stock. This allows us to understand how much of the company would be comfortable owning in an attractive valuation environment. It's very important we make this decision beforehand, before we enter a very volatile environment. It's always important to check the parachute before you jump out of the airplane. And the final piece is the investment decision. And this is where the rubber meets the road. This is where we pay closest attention to valuation and entry points. Critically, this comes last. There's a real danger to looking to valuation and then looking to quality and then looking to risk sizing. The sequencing is critical. It's very, very common in my experience and very dangerous to look at valuation first and then back into what is a quality assessment. It can cloud and pollute your thinking. It must come last. And this is a couple of slides just outlining why we think valuation is really important. Everything I talked about in quality, that's about your ability to deliver earnings, revenue and earnings, the fundamentals of our business. But that alone is not enough. You can buy the right stock at the wrong price. And here are a few examples. This is a particularly outrageous moment we picked in 2000s. But these are a few examples of companies where you could get your stock selection right, you could say this will be a winner over the long term, and you'd been completely correct, but you would have still lost your shirt because you bought at the wrong price. And this is an example, an extreme example, but a relevant one of why you pay attention to the price you buy at. So we've got Microsoft, Cisco, but then it's not just tech. We've got Walmart as well, and then Amazon. And noteworthily, all of them, you've been underwater for many years, uh, well beyond what we think any investor could sustain, before you made back your nominal entry point. And I'm not talking about your hurdle in terms of cost of capital, particularly your inflation adjusted cost of capital. And then the final slide, this gets into the heart of it. Valuation matters, but valuation is incredibly hard to assess. And what we've got here are a few examples of companies which are operating roughly the same industry with very different initial valuations, but where we would be very, very cautious about taking the cheaper one, and where the more expensive one, you've been compensated for that lower valuation because, as mentioned earlier, these are all companies which have sacrificed earnings, sometimes in a very material way, in order to guarantee themselves of a longer pipeline or runway. And I could itemize some of the ways they differ. If you look at a Kering versus a Hermes, there's a cost to just distributing through your own owned and operated stores, but that's a price worth paying. But MasterCard, there's a cost to rebating so much to your partners. There's a cost to having a very large research and development pipeline, to having businesses which are currently unprofitable. But these are all prices worth paying because they give you that line of sight 5, 10, 15, 20 years ahead. The challenge is how to quantify this systematically. And we have a number of ways of doing this. Most importantly, they're applied systematically across our investment opportunity set. And that takes us to the final slide where we talk about valuation, business, and fundamentals. They come together. I hope you get the sense going through this that this is fundamentally, there's a large element of art to this, and it's about experience. It's about learning from your experience. You do have to pay attention to the data as well. But ultimately, when we deal with companies, we're dealing with human beings. And science has got a limited amount of purchase on its own on human beings. You need to be able to marry the data to that understanding of human behavioral tendencies, bring them together, and then have that total commitment to preserving and growing client capital in real terms over the long term. And that's Evenlode in a nutshell. Talked about the alignment of the business with our clients' interests and our mission. We've talked about our focus on the fundamentals of companies, in particular, those fundamentals which gives you better line of sight towards your future compounding. And finally, we've talked about our focus on valuation and our understanding of the sensitivity of client outcomes to your valuations. A lot has changed since we were set up in 2009. The world has become, if possible, more complex, more uncertain. Maybe that's possible, maybe that's not. Feels like it at times. Our business has become bigger in headcount, in assets and capabilities, but nothing has changed about what we do, the focus of our process and our philosophy, and our commitment to our clients over the long term to preserve and grow their capital. So thank you all very much for joining us today. I hope you enjoyed that brief introduction to who Evenlode are, what we do, and our commitment to our clients. And if you have any further questions, please don't hesitate to get in touch with Curate. Thank you all very much.